The Connors RSI consists of three separate components that work together to provide a comprehensive momentum indicator. These three components are averaged to create the final Connors RSI value. The first component is the traditional RSI calculation applied to price changes. This measures price momentum using the standard RSI formula developed by Wells Wilder. The second component is the streak RSI, which measures the duration of consecutive up or down days. This component identifies when price movements in one direction may be overextended. The third component is the percentile rank RSI, which evaluates where the current price is positioned within its recent trading range. This helps identify extremes in price. When these three components are combined, they create a more robust indicator that provides multiple perspectives on market conditions. The key benefits of using Connors RSI include more comprehensive market analysis, better identification of trading opportunities, and reduced false signals through component confirmation. The first component of Connors RSI is the Traditional Relative Strength Index, or RSI. This indicator was developed by J. Wells Wilder in 1978 and has become one of the most popular technical indicators. RSI measures the speed and magnitude of price movements on a scale from 0 to 100. Values below 30 typically indicate oversold conditions, while values above 70 suggest overbought conditions. The RSI formula is straightforward. First, we calculate the relative strength, or RS, which is the ratio of average gains to average losses over a specific period. Then we convert RS to the RSI value using the formula RSI equals 100 minus 100 divided by 1 plus RS. This normalizes the result to a scale between 0 and 100. The calculation process involves several steps: calculating price changes, separating gains from losses, averaging them, calculating RS, and finally computing the RSI. Now let's compare the traditional RSI settings with those used in Connors RSI. The traditional RSI typically uses a 14-period look-back window, while Connors RSI uses a much shorter 3-period setting. This shorter time frame makes the indicator significantly more sensitive to recent price changes. As a result, the 3-period RSI generates more trading signals, making it better suited for short-term trading opportunities. Let's visualize how 3-period and 14-period RSI respond differently to the same price movements. Here's a sample price chart showing typical market movements. Below, we can see how the traditional 14-period RSI responds to these price changes with a smooth, gradual movement. In contrast, the 3-period RSI used in Connors RSI is much more responsive, quickly reaching overbought and oversold levels. This increased responsiveness offers several key benefits when used in the Connors RSI indicator. First, it quickly identifies overbought and oversold conditions. It's highly responsive to recent price action and particularly well-suited for short-term mean reversion strategies. The key takeaway is that this shorter 3-period setting makes Connors RSI significantly more effective for short-term trading compared to the traditional RSI. The second component of Connors RSI is called streak RSI. Streak RSI measures the length of consecutive up or down days and applies an RSI calculation to this streak data. To understand streak RSI, let's visualize price movement on a chart. A streak is defined as consecutive days where the price moves in the same direction. For each day, we assign a streak value based on how many consecutive days the price has moved in the same direction. These streak values are then used to calculate the streak RSI component using a standard RSI formula. The purpose of streak RSI is to identify when a trend might be overextended and due for a reversal. When a security has been rising for several consecutive days, the streak RSI will increase, potentially signaling an overbought condition. Similarly, extended down streaks result in low streak RSI values, potentially signaling oversold conditions. The third component of Connors RSI measures where the current price sits relative to its recent trading range. Percentile rank determines where today's price falls within a recent historical range, typically looking back at the last 100 periods. Let's examine the calculation process. First, we collect price data from the last 100 periods. Second, we calculate the percentile rank of the current price. This is the percentage of prices in our look-back window that fall below today's price. Finally, this percentile value is processed through an RSI calculation to produce the third component of Connors RSI. Now let's discuss how to interpret this component. High readings above 70 indicate that the current price is near the upper range of its recent history, suggesting potentially overbought conditions. Conversely, low readings below 30 suggest the price is near the lower range of its recent history, indicating potentially oversold conditions that may lead to a bounce. This chart visualizes how the percentile rank component identifies where the current price sits within its historical range. The red zone represents the upper percentiles, while the green zone shows the lower percentiles. To summarize, the percentile rank RSI component measures where the current price sits within its recent trading range, typically looking back at the last 100 periods. It helps identify when a price is historically high or low, which can signal potential trend exhaustion points and upcoming reversals. This component works together with the traditional RSI and streak RSI components to form the complete Connors RSI indicator, providing a more comprehensive view of market conditions than any single component alone. Interpreting Connors RSI signals focuses on identifying overbought and oversold conditions. The Connors RSI ranges from 0 to 100, with key threshold levels that signal trading opportunities. Readings above 70 are considered overbought, suggesting potential selling opportunities, while readings below 30 are considered oversold, indicating potential buying opportunities. Extreme readings below 10 or above 90 signal even stronger reversal possibilities. Unlike the traditional RSI, the Connors RSI is designed to reach extreme levels more frequently, providing more trading signals. The Connors RSI's ability to reach extreme levels more frequently makes it a valuable tool for short-term traders seeking precise entry and exit points. Now we'll explore the 3 most effective trading strategies using Connors RSI. First, let's examine mean reversion trading with the Connors RSI. This strategy capitalizes on extreme readings in the indicator. In mean reversion, we look for oversold conditions where CRSI falls below 10, creating buying opportunities. Conversely, when CRSI rises above 90, we identify overbought conditions that present shorting opportunities. Our second strategy is trend confirmation, where Connors RSI is used alongside other trend indicators. This approach waits for alignment between trend indicators and CRSI readings before entering trades. By requiring confirmation from both signals, you filter out potential false moves and improve trade quality. The third strategy is divergence trading, a powerful technique for identifying potential reversals. Divergence occurs when price movement doesn't align with Connors RSI readings. For example, when price makes a higher high but CRSI makes a lower high. This disagreement often signals weakening momentum and a potential trend reversal, offering high-probability trading opportunities. Let's summarize these 3 powerful trading strategies using Connors RSI. Each strategy works best in specific market conditions. Mean reversion for ranging markets, trend confirmation for directional moves, and divergence for potential reversals. Let's explore how to optimize Connors RSI settings for your specific trading needs. The default Connors RSI settings use RSI with a period of 3 for price, RSI with a period of 2 for the streak component, and 100 periods for the percentile rank calculation. The RSI period settings significantly impact the indicator's sensitivity. Here we can see 3 different RSI period settings and how they affect the indicator. The RSI with period 2 shown in red is more sensitive and generates more trading signals, but also produces more false signals. The RSI with period 7 shown in yellow offers a balance between sensitivity and reliability. The RSI with period 14 shown in green is much smoother and generates fewer signals but might miss shorter-term opportunities. When optimizing your Connors RSI settings, consider these guidelines. Shorter periods make the indicator more sensitive and generate more trading signals, but this comes with a higher risk of whipsaws. These settings are better for short-term trading. Longer periods create a smoother line with fewer signals, reducing the risk of false signals. These settings are better for capturing longer-term trends. Different market conditions require different parameter settings. For volatile markets, use longer RSI periods to filter out noise. For range-bound markets, shorter periods can help capture reversal opportunities. Always backtest your settings across different market conditions to find what works best. Here's an example of how different Connors RSI settings might perform in backtesting. Each configuration shows a different win rate based on historical performance. Testing multiple configurations allows you to identify which settings perform best for your specific trading style and markets. In this example, the RSI 72100 configuration achieved the highest win rate at 78%. Here are some final recommendations for optimizing your Connors RSI settings. Start with the default settings. Then test at least 3 to 5 different configurations. Optimize specifically for your trading time frame and adjust your settings based on current market conditions. Always document your test results to refine your approach over time. Let's explore the limitations of the Connors RSI indicator and the best practices for using it effectively. The Connors RSI, like all technical indicators, has several important limitations to be aware of. First, it can generate false signals during strong trends. When the market is trending strongly in one direction, the indicator may signal overbought or oversold conditions prematurely. Second, extreme readings in the Connors RSI can persist longer than expected, especially during extended trends. This may lead to traders entering positions too early. Finally, the Connors RSI performs differently across various market conditions. It tends to work best in range-bound markets and may be less effective during strong trending periods. For best results, combine the Connors RSI with other technical analysis tools such as support and resistance levels, trend lines, or moving averages. It's crucial to use appropriate stop-loss orders when trading based on Connors RSI signals to protect against false signals and unexpected market movements. The Connors RSI indicator works best in range-bound markets, where price oscillates between support and resistance levels. It should be used with caution during strong trending conditions, as this is when the indicator is most prone to generating false signals. Remember, it's essential to thoroughly test and validate any Connors RSI strategy in your specific market conditions before trading with real capital.